Hi there, folks. Joe McQuaid, Wealth Preservation Associates here. Great to be back with you. A few weeks ago, we put together an initial video in an attempt to try and help some of our clients who may be thinking along the lines of time to get some planning going as far as our retirement is concerned. And we do know a number of the viewers came in and did take a look at the video. We're hoping that the information was helpful, and what we plan on doing today is, for all intents and purposes, updating that information. Again, sometimes when we look at something, it tweaks us a little bit, raises some questions in our mind. Is this something I want to take a look at? And I think as we continue to pursue the best balance for our clients, as far as their retirement portfolios are concerned, we continue to come back to what we think is an excellent opportunity and an excellent set of products for all folks who are either near retirement or in retirement to take a look at to help preserve their wealth and protect their assets as they move forward. And that is one of the key things that we try to accomplish here at Wealth Preservation Associates. So let's jump right into it. It is, for many of you, just going to be an update. For some of you who didn't have a chance to take a look at the first video, this may be an initial introduction. In the interest of time, I'm not going to go deeply into the details, but I would like to immediately just open up an invitation to you to give us a call, contact us through our website, or contact us at our telephone number, 407-593-2243, and we'd be happy to set up a free consultation to go into more detail on some of the things we're going to present today. So with that being said, let's get started. What you have on your screen here is a chart. That chart represents three different investment types of products. You have at the very top of the chart here where it says indexed annuity. That would be the green line, and as you can see, that green line moves up in a certain growth pattern. Below that, you have the direct investment in the S&P 500. And for those of you who are familiar with the stock exchanges, you have in the United States, the traditionals are the NASDAQ, the Dow Jones, and the S&P 500. S&P 500 is one of the more popular investment choices for a lot of financial advisors because it is comprised of some of the largest and the greatest corporations, publicly traded corporations in the world. And then the third investment we're looking at is the what I call the fixed annuity, and that is basically a straight line. Call it a CD on steroids, if you will. So let's take a look at what we have here. The simplest to explain, and I'll explain that first on this chart, is the blue line, and that is the fixed annuity. The fixed annuity, as you can see, we're starting at a measurement point in 1998, and then we're running through 2014, and gives us a good indication of how these products perform over an extended period of time. And in this particular case, the fixed annuity is a straight line solution, just like a CD, like a savings account or a money market. It will give you a fixed amount of interest for a guaranteed period of time. And in this case, we're extending the guarantee probably a little bit longer than most fixed annuities go. They usually go for about 10 years. This is measuring for 14 years, but it's showing you about a 3.5 to 3.8% growth year after year. Now, the good thing about it is the day you invest in this kind of product, from that point on, that is the return you're going to get. So as I said, it's like a CD on steroids. Lots of folks like the safety of CDs, safety of a savings account. This will deliver that kind of safety and will give you a little bit more interest return on it. Second investment here that we want to take a closer look at, give it a little bit more explanation, is the S&P 500, the red line. And as you can see, this is an investment that is directly in the stock market. When it starts in 1998, it has a tremendous growth up through 1999, 2000, early 2000. The reason it downturns at that point, and downturns significantly, is one of two events that took place, and that was the internet bubble burst, which started to take place in the early part of 2000. And then that was piggybacked almost immediately a year later by the terrorist attack of 9/11. So as you can see, over that 2-year period, there was a tremendous loss on this investment. Not only was there a loss of gain, but there was also a loss of principal. Following 2001, we had a period that was down for about a year until the market started to come back up. But then, as you can see from the slope here, they came up rather significantly through 2006. And then in 2007, we had the next downturn, which I'm sure all of you are even more familiar with because it's more recent. And that was the housing bubble burst of 2007, 2008, which also led to the financial distress that we ran into in that period. So at that point, for the next 3 years, we're seeing a downturn in that investment to the point where after a full 10 years of being in that investment, you're actually looking at having about the same amount of money when you started back in 2000. So that's not all good. And then beyond that, as you can see, again, we see a significant growth incline, which has been taking place over the last 4 or 5 years. And again, for you who are invested in the market, you've been feeling pretty good over the last number of years. But as you can see, and as historically has always been, the markets are very cyclical. They have the peaks and they have their troughs. And the tendency that we have is as things get towards the peak, we say, we don't want to miss out on this. So we jump in and we stay in till it has a significant loss. And then we get nervous and say, well, we can't lose everything, so we get out. Well, we have a solution to that, and it's called an indexed annuity. An indexed annuity, as you can see here, has a growth pattern which is similar to, not as good as, and never exceeds how the actual markets take place. This fixed annuity happens to be invested in an index that tracks the S&P 500. And as it goes, as the S&P 500 goes, it shadows it at a lower percentage, but it is shadowing it as it goes up. The beautiful thing, and this is where I like to coin the phrase, zero is a hero, is for the 3 years that we had the market downturn, as you can see, the fixed indexed annuity just goes flat. Once the market starts to turn back up, so does the indexed annuity. But as you can see, it has a higher starting point, so it is going up. It's getting a significantly higher number of dollars in it than you have in your original S&P 500 investment. So at the end of the day, after about a 10-year period, we're seeing that the market index investment, the direct market index investment, is worth about $100,000, and the indexed annuity is worth about $156,000. Now we turn back up again, and as I say, we've had significant growth over the last 5 years, and you can see how the trending has taken place. Again, the indexed annuity has outperformed because of the fact that it always has a higher starting point when markets turn down. And this is the kind of investment that in your retirement portfolio plan will give you a conservative type of investment with very competitive growth and quite a bit of safety. So contact us. Let's talk more about it. This might be something that you want to have in your portfolio. Joe McQuaid, Wealth Preservation Associates, and thanks so much for your time today.